Hello everyone, welcome back to your chapter 9 session. So we talked about the special purpose entities in the previous lecture, and now we are going to jump into the joint ventures. So so the companies could have different kind of relationships between different kind of entities. So one of that is the joint ventures. Sometimes what happened is companies wanted to get into a project. So that project could not be a short-term project, could be a long-term project that could last from anywhere from 20 years. Uh, Now 20 years is a lot of time, but now companies may don't want to create a separate company and get into the issue of the shares issuing and the legal structure. So what they will do is a group of companies could put together a joint venture agreement and create a joint venture versus creating a new entity. So if those kind of joint ventures exist, and then if that does, and then the companies who are involved into that, they have an obligation to the users to know what kind of joint ventures they are getting involved in. So if there's an arrangement that happens which has a specific timeline, and there are a number of companies who are involved into it, then obviously these rules under the IFRS are applicable for such an arrangement. So now when does the joint arrangement happen? The joint arrangement is a contractual arrangement between two or more parties undertaking an activity together and jointly controlled that activity. So as it states, it has to be done by either two or more entities. So if they are working towards a joint goal or joint activity, and those are dictated by a contractual agreement, then we know that there is a joint arrangement and joint venture exists. Joint arrangements are established for a variety of purposes and can be established by using different structures and a legal form. So when I said about the joint ventures, now joint ventures could be arranged by having a corporation, a partnership, a sole proprietorship. It could be done in any form. So there has to be a legal structure that need to be put into place, and those legal structure will be dictated through a contractual arrangement as well. So it could be done in any form. It doesn't have to be a corporation. It could be a partnership. Could be a any other kind of form that may exist in a legal world. In a joint arrangement, a party spends contribute resources to carry out a specific undertaking. So, so when these joint ventures happen, there always some kind of a cash or an asset that need to be transferred from one company to another. If that is the case, then obviously those has to be dictated in the contractual agreement as well. So now when it comes to a joint arrangement, it's classified into two different types. One is a joint operation, another one is a joint venture. So joint operations means that you put some resources together to run a business. Okay, so that's the joint operation. Whereas the joint venture could be that maybe you wanted to get together to create an asset or create a particular division or buy a certain asset and then run it for a certain number of periods. Or you could do the joint venture by either putting some funds together and doing some kind of a financing through the two different projects. So depending on if it's operational or it's just a small assets that are being built, that could dictate the different types of ventures that may exist. Joint operations are the ones that operates use of assets or resources to put a new activity but retains titles and control of the assets and resources. So in that case, you mostly focus on the activity, not on the assets or the resources. The example could have been the case in which one operates manufactures part of the product, second operates the complete manufacturing process, the third operates handle of marketing of products, with each operation using its own assets, its work. So everybody will have its own work, and they are simply operating and charging their fees based on what kind of operations they are taking, and then the third company will run the operations. Whereas the joint venture is an arrangement where the parties that have joint control on the arrangement have the rights to the net assets of that arrangement. So now that's where the difference comes in. So in this case, joint venture will have its own assets, and then the companies who have, they will have the right to those assets. An entity is a party to joint venture when the separate vehicles has right to the assets and the responsibility for the liabilities. So in that case, the joint venture will definitely will have its own titles to their assets and the liabilities as well. So in that case, everything that's there is owned by that particular joint venture. So in the joint venture, the ventures contribute assets to a separate legal entity which has a title to the assets. So now in that relationship, what happened is a joint venture could be a separate legal entity or a partnership, or the way that is being structured. So technically, it won't be a partnership when it's a separate legal entity. So in that case, it has to be done in that way that there is a legal entity that exists and that will have its own assets under its own name. So now if the venturers wanted to contribute anything, they will have to physically transfer those assets, not physically, but to transfer those assets by sale either or by putting a cash and considering some kind of an agreement to repay those debts. So those agreement has to be done, but there has to be title has to be transferred from one company to another, so that way the assets are not owned by the venturers, it will owned by that particular joint venture. The accounting principles involved with reporting joint ventures are contained under the IFRS 11. So IFRS 11 that's primarily focused on the joint ventures. So Appendix A that you have in IFRS 11 represent the following definitions. And there's a joint control. So what is joint control? Is a contractual agreed share of control arrangement which exists between the decisions about the relevant activities required unanimous consent of the parties sharing controls. So that's the definition for a joint control. Whereas a joint operators is a party to joint operations that has a joint control of the joint operations. So operations is always talks about the activities that it's doing. So that's how you will determine who has the joint, who is the joint operator. Joint ventures is the party of a joint venture that has a joint control of that joint venture. So joint control is a key feature of a joint arrangement. This means that no one ventures can unilaterally control the ventures regardless of the size of the equity. So if you have a joint control, that technically means that you have a control on the company's operations. So it's not looking at the equity contributions, it looks at the controls that being held. So under the IFRS 11.2, the joint operators must recognize the relationship between interest in the joint ventures, its assets, liabilities, revenues, shares, and the expenses. So the way the joint venture works is that everybody or the venturers who are involved, they must take their interest in the joint venture, and they must take the portion of their shares and must report all the different assets in their financial statement. So it's not only the asset, but they will look at their part of their contribution. So if they are, for example, I own 20% of that joint venture, so I have to include 20% of the asset, liabilities, revenues, expenses in my financial statement, as I owns the asset, not only the asset but all the different components of the financial statement. So I must include that in the financial statement of in my financial statement at the time of the reporting. So under the IFRS 11, the venture must use the equity method to report investment in a joint venture. So obviously when we are doing the equity method, we are making a proportional consolidation. So in that case, when you're doing that, you first record the value so you have to record the investments using the equity method. So when you're using an equity method, you are reporting the assets, liabilities, as well as any changes in the revenue and expenses. Your portion of that must be recognized as an income, and then obviously you offset against your investment account. And then the following adjustments are required for its interest, for its shares only. So if I own 20% shares, so if there's an acquisition differential that exists when I took over the control, I must do the allocation of the acquisition differential as well, but only my portion. So it's only your shares that you are considering and reporting into your financial statement. For joint ventures, the venture shares of intercompany assets profit is eliminated as well. So when we're doing consolidation, we always eliminate the full amount, which is 100%, and then we allocate between the NCIs on the financial statement on the balance sheet. But when we're doing a joint ventures, you have to eliminate only your portion of those unrealized gain and losses that exist on the assets or inventory. Okay. Contribution to the joint venture, if we continue with that, on the date formation joint venture, instead of contributing cash, ventures contributes asset, receive interest in the joint venture, and then obviously that assets contributed have a fair market value that is greater than a carrying value, so you must record those assets at a fair market value. The requirements set out in the IAS 28 to deal with if it be appropriate for the venture to record gains from the investment of these non-monetary assets. If so, how much and how should be recognized? That is the big question that exists, is if there are, so if somebody contributes the monetary value, a non-monetary asset that exists, you can determine the fair market value. But if there was no assets being transferred, what it does is it's simply providing certain services. So if that is the case, we have to determine what the value will be, and if there are gain and losses that need to be recognized from there. So IAS 28 talks about those kind of scenarios. So in IAS 28, the investors should record the investment should be recorded at a fair value of the non-monetary asset transferred to the joint venture. So if there is a fair value exists, you must record that value at a fair market value. Only the gain represented by the interest of other non-monetary ventures should be recognized on the date of the contribution, only if the transaction has a commercial substance as the term described in the IAS 16. So if there is no commercial substance, and what is commercial substance means that this has a value outside, so it has some commercial value that exists, and then you may want to go look at the IAS 16 what the definition of the commercial substance is. So if it does, then you will recognize that gain at the time when the interests were transferred. Now, what if there is no commercial substance exists? The entire gain is considered to be unrealized unless the venture receives an asset in addition to the interest in the joint venture. So if there is no commercial substance exist, then that gain cannot be realized. So what happened is we'll consider that to be unrealized, and then can only be realized when if there are physical assets that may get transferred to the joint venture in the near future. A portion of the gain represented by the venture's own interest should be unrealized until the asset has been sold to the unrelated outsider for the venture. So now if you say that there was no substantial assets or no commercial substance exist, so in that case the full amount will consider to be unrealized. So at what time we can recognize that is only either you transfer some assets, or you will do is when you create a value and you sell those values to the outsiders, and then you realize that gain at the time when those assets were sold to the outsiders. Now, what happens if there was a loss? If a loss results in the recording of investment, the portion of the loss represented by the interest of the unrelated ventures is recognized immediately into the income. When evidence the assets contribute to the joint venture is impaired, the entire loss is immediately recognized. So that is the case. So if there is loss that exists, you must recognize directly into your net income right away. So an investor in a joint arrangement is a party to a joint arrangement, but does not have a joint control over the joint arrangement. And we always wanted to make sure that we need to differentiate in what is a venture and who controls the who controls it, and who are the investors who do not have a control. So those kind of things must be considered when we talks about the joint venture. So you always have to consider the joint control over the joint arrangement. So joint arrangement is simply an arrangement, whereas the joint controls dictate who controls it and who are the key decision makers. But it is simply just for the control purposes, as whether the consolidation is required. If the joint control exists, you are the party who controls it, then you have to make sure you consolidate it, and that's only done on a proportional basis. But if there's no joint control, then obviously then what we'll do is we'll use the equity method and record the investment using the equity method and eliminate the profits only based on the proportionate. And now comes to the disclosures. So the disclosures, there is IFRS 12 require the entity to disclose the information that enables users of the financial statement to evaluate the following. Number one is the nature, extent, and the financial effect of interest on the joint arrangement. So what is the risk and how extensive are we involved into the particular joint venture? Okay, so you wanted to make sure the contractual relationship that exists, so you must disclose to the investors what that arrangement is. Nature of and changes in the risk associated with the interest in the joint venture. If there is any risk that exists and those risks has been changed year over year, you must disclose that in the disclosure as well. Okay, so these are the two primary things that must be disclosed if the company is involved into the joint venture. All right, so this wraps up your topic for the joint venture, and I definitely recommend you guys to go through the chapter. As you read through it, there is an example that is there that you guys can use to understand how the intercompany transactions work and the elimination process that involves into the adjustments as well. Okay, and then after we finish up the chapter 9 readings, chapter 9 lecture, may bring up some of the questions from joint ventures, and let's focus on the consolidation of the joint ventures as well. So I'll wrap up the video for this, and then I'll see you in the next video, which will focus on the income tax, deferred income tax, and how does that impact under the business combination. Take care, everyone.